with Discover Options. Welcome to this presentation of superb results with the VXX Trading System. Can you guys do me a favor and just go to the bottom right corner in the chat feature there and let me know that you can hear me just fine. Let me move this bar around just a squeege. Just want to make sure that we are good. And if you can just type in yes or something in the bottom and click send, I would really appreciate knowing that you guys can hear me okay. Awesome. Thank you very much, Philippe. Folks, Discover Options is a part of OptionVue Systems International. OptionVue Systems has been in business since 1983, primarily involved in the high-end options analytics software field. If you've ever wanted theoretical values of option prices and modeling of sophisticated positions, OptionVue has been about as the most advanced that the trading public could acquire outside of being in an institution with their own programmers and everything. And so Discover Options is the educational arm focused primarily on one-on-one mentoring. And then the VXX Trading System was rolled out here a few years ago. And today I want to show you everything about this system. It's an advisory we have, but I'm going to show you the philosophy, the indicators, and a lot more today in about a 35-minute presentation. Okay, so with that said, here we go. You should know presenter material today is for educational purposes only and should not be construed as personalized financial advice. Past results not necessarily indicative of future performance. So let's take a look at this equity curve here. All right, here is an equity curve of $10,000 started when the set of rules that we rolled out here about 2.5 years ago came out, March 6, 2016. Starting with $10,000, bottom right corner of this screen, you can see that the return since then has been 260%. On an annualized basis, it works out to about 103%, and that's through September 14th of 2018. Now, during that time, we've had about a 31% drawdown. That was our maximum in that time frame, and that's very consistent with what we have had with the back testing we did before we went into this 2.5 years ago. Back testing works out to about a max drawdown of 39% since 2009, and what you see here is par for the course in terms of our back testing. We're very happy with these results, and today I want to show you everything about this and what goes on here. So, but basically, if at the end of this you want to, invest a portion of your capital into this, know that there's a degree of volatility, but then again, we're shooting for triple-digit returns in the long run as well. Okay. So you were out in Feb 2018. Out? What do you mean out, Joseph? You can see here. Well, you'll see here that there's some flat regions. Okay, and what you'll and I'm going to explain this, and it's going to become very clear exactly why you have some flatness. Yes, Joseph, we were in cash where you see flat regions there, and there's a very good reason. You should know that our approach does not use technical analysis of the price action at all. Okay, and there's a whole other angle that we take in generating these signals. Here's what the VXX Trading System is. It was developed by Len Yates in our office. He's the founder of OptionVue, the chief programmer, and the president. And it times the entry and exit for your capital to be placed either long the VXX, that's the iPath S&P 500 VIX short-term futures exchange traded note, or you could be long the SVXY, the Pros Shares Short VIX ETF, or your money would be in cash. Okay? Now, both the VXX and the SVXY pertain to something called the VIX, and I'm not going to assume that everyone listening knows what the VIX is. So for those of you that are veterans, just bear with us here. I'm going to digress for just a second, explain the VIX, and then we'll come back to the trading system. But the VIX is very important that we understand this. Here is a bar chart of the S&P 500, or the SPX. You have two lines underneath, the blue and the red. Never mind the red. We're going to look at the blue line primarily. Now, the SPX, the S&P 500 index, is exclusively licensed by the Chicago Board Options Exchange, the CBOE, or what we call in the industry the CBOE. the SIBO for short. And many years ago, the SIBO, I'm going to say back in the mid-late 70s, the SIBO rolled out cash options on the S&P 500 index. And since then, they have had a measurement of the expensiveness or cheapness of those options called the VIX, and that's the blue line you see here. So the options have time premium. That time premium implies a certain volatility in the future. And the VIX is a running 30-day volatility level implied by the 30-day options. And so every day they have to do a recalculation to extrapolate what the 30-day options are implying. But the blue line here reflects that volatility level. Notice that when the index drops, the options get far more expensive. They imply a higher level of volatility. Instead of 9 or 10, they're implying 14 or 15 right here. When the market bottoms and goes up, the VIX, or the volatility implied by those options, begins to come down. Now, what's going on there? Well, what you have is a huge population of investment managers, institutions, money managers that are sitting on billions of dollars of long equity holdings. And when the market begins to go down, they can't really quickly get out and then back into the market. Some of those positions are so large that it would take them days, if not weeks, for some of them to wind out of those positions, much less come back into those positions. And so instead what they do is hedge their holdings using various derivatives. And one of the main derivatives to use are put options sold by the at the SPX market here. And so you can see that when the market then goes down like this, those institutions and money managers rush in and buy put options that drives the price of the options up, and you'll see the blue line then go up. But when the market bottoms and goes up, the hedging activity by the put purchases comes way down then. Now, after many years, the SIBO had a great idea, and that is they came out with a futures market on the VIX itself, a futures market on the movement of this blue line here. So that now, and you know, you can have a futures market on most anything, on currencies, interest rates, the price of cattle, corn. I mean, it seems to, you know, cryptocurrencies, it's just endless, right? And so now with this, and it's a very liquid market now, when the market begins to come down, the money managers can go in and go long VIX futures, and then those futures increase in value and make them profits as the market continues to go down. And in that way, they're partially or fully hedging their long holdings. So today we have a vast market on VIX futures, and that's the point here. That's the exercise. So with that understood, let's go back to the system, the VXX trading system, and take a look at what you get when you buy VXX or the SVXY. When you're long the VXX, you're purchasing shares of a stock, so to speak. Your money is being used by a money manager in a fund, so to speak, an exchange-traded note. Your money is being used to manage a long VIX futures position. Okay? If your money is instead long the SVXY, that's an exchange-traded fund that manages a short VIX futures position. Now understand, your money, you are not personally trading in VIX futures. Your money is being used in those instruments to adopt a position in the VIX futures. So it's VXX shares or SVXY shares are entirely appropriate for IRAs, 401ks, etc. Okay, so no worries there. And if you're not in either one, you would be in cash then, of course. All right, now, before we get into the philosophy as to how we swing in and out of these, just a few items of full disclosure. We have a VXX Trading System advisory. We email out trade alerts and signals using the methodology I'm going to show you in just a second. We give all our subscribers access to the proprietary indicators and more through both a member section of our website, and if you're an OptionVue software subscriber, you get access to those in the software itself. You don't have to be a subscriber, though, of OptionVue to take part in the advisory. Finally, we have a great a monthly email that goes out at the end of every month summarizing how things went. And then we have a subscriber forum that's fairly active as well. Okay. Now, finally, if you decide to allocate capital toward this approach, you have the VXX that averages over 27 million shares traded per day, very liquid, and the SVXY averages over 8 million shares traded per day. So if you get a signal to go long or to get into cash, know that you can go in and get your order executed fairly easily because these are very liquid items. Here is the heartbeat of what drives the VXX trading system. It's called the Yates VXX indicator, or the YV for short. It is a 15-day moving average of a component that it's going to take me a little while to explain. But suffice to say, when this indicator, and I'll fully explain it in a sec, when the indicator goes up above a certain threshold, okay, that's a signal to go long the SVXY. When it declines below that threshold, in this case about 3 months later, that's a signal to go back into cash. When it rises back above the threshold, okay, we go back in the SVXY and it exited it in cash, in this case about 3.5 months later. And then 2 weeks later went back long the SVXY and exited into cash. Note that this approach that we have in the advisory is not a short-term swing trading approach. You have the position on for weeks that turns into months. And there's a good reason, and you'll fully understand that reason here by the end of this. Okay, let's take these three signals. Let's take these three signals, superimpose them on a chart of the SVXY, and let's just see how well those signals did using the YVI indicator. Here, right when we began, March 7th, 2016, went long the SVXY at 345, exiting 3.5 months later at 487 for a gain of 41%. 2 weeks later, went back long the SVXY at 432, exiting at 582, roughly 3.5 months later, for a gain of 35%. 2 weeks later, went long in mid-November at 657, exiting into cash in late March for a gain of 73%. Now watch this. If you take capital you're allocating to this approach, and you make 41% on it, and then you're out, and then 2 weeks later you get another signal to go long, and you reinvest all your original capital plus the amount you gained, all right, that 41%, and you reinvest it at full strength, and you make 35% on that number. Then you take your original capital plus all your gains and reinvest and make 73% on that. I think you can see that your capital can begin to grow very quickly. And indeed, we went back to 2009, took all the signals starting in 2009 and assumed that you went full strength, okay, going 2 times your investment and just put the pedal to the metal down, even investing on margin, okay, and if you did that, $10,000 invested in 2009 would be worth over $9 million today. It's incredible when you have that kind of power of the exponential returns. That's full strength. You're not taking anything out, of course, and you're investing at 2 times capital or 50% margin on the stock shares. Okay? So, want to point that out. This thing could be quite dramatic, but that's what we're accepting the volatility as well. And this includes the drawdown, the max drawdowns. All right, now, here's the thing though. I mean, we know there's volatility, but the returns are outstanding. There were 62% winners out of 37 trades in that period of time. And here's the question I want to answer right now. Why does this trading system work? Well, as I mentioned, we are not looking at technical analysis. We have not cracked the code of reading the VIX charts or the SPX charts as it pertains to swinging in and out of these instruments. Instead, we look at something entirely different, and that's called the daily roll. The daily roll. Joseph, this thing is in positions for weeks into months. Okay? Yeah, I don't know about what you mean by overnight protection. You're buying shares and you're in, and you're just keeping the positions on for a period of weeks that turns into months in this case. Here's the reason this works. It's not because of cracking the code of technical analysis. There's something here called daily roll, and I want to explain this clearly to you. And to do that, we have to go to the VIX futures, because the daily roll is what drives the signals here. And it comes from the VIX futures. And I want you to study this. This is from January of 18, early January this year. We were in a bull market at the time. Notice that the January VIX futures was priced at 1090, and as you go out further in time, the prices ascend upward so that September is at 1608. Okay, now why are the numbers ascending like this? If we're in a bull market, why are the numbers ascending? And to answer that, let me ask you a question. Which is more volatile, a bull market or a bearish market? A bull market or a bearish market? I think if you've been around very long at all, okay, and hopefully some of you have been around since 2018, or excuse me, 2008, fall of 08, okay, I mean, we know that a bear market can be far more volatile than a bull market. In a bear market, the daily ranges can be huge. They could be 1% of the index sometimes. We had a couple of those here the other day, okay, or more. So the daily ranges can be very wide. The opening gaps can be extreme. Everyone's on pins and needles. But yet when the market then goes into a bull market, okay, the upward movements can be kind of choppy. Some days can be very narrow range days. The gaps really, can be non-existent sometimes. So, I think we can agree that a bear market is entirely more volatile. So why are the numbers like this? Well, if it's a bull market, we're sitting in January, we know that over the next few months, we're going to have kind of volatility that's still in the bullish territory, kind of low. But you know what? The farther out in time we go, the greater likelihood there is that we'll have a bear market, and with that bear market comes what? More volatility. So that's why you have an ascending term structure like this. Now, with that said, let me ask you this. If we're in the middle of a bear market, let's say we're all on pins and needles. It's fall of 08. Okay, getting into the, the holidays of 08, all right? We're all on pins and needles. What would this term structure look like then? Indeed, these numbers could be completely inverted, okay? Completely inverted. And you could have January sitting at 16, and you can have September down at 10. All right, completely inverted. Why? Because we're all on pins and needles. We're pretty certain that over the next month or two, things are going to be crazy, but eventually, the farther out in time we go, all right, the greater likelihood there is that the market will settle down. The Warren Buffett's on the world sitting on, billions waiting to come in. They'll come in and scoop up those bargains. The market will bottom and then begin its long-term bullish bias and start going up again. And so that's why in a bear market, we would have a descending term structure. High to low. In a bull market, it's ascending, low to high. Does that make sense? So with that stated, let's go back. No, we're not going to go back. We're going to go and look at a quote from Larry McMillan. He rolled this idea out in February of 12 in his Option Strategist newsletter. And I'm just going to quote him because this was the beginning of the idea, and Len Yates in our office passed this around the office, and we really teed off on this, and we've built this out huge. And so here's the idea. Here's from Larry. Both the VXX and the XIV, or the SVXY. Now, stop right there. The XIV was the venue of choice for years for those that wanted to go short the VIX. Well, when you had the when the market got real volatile this last February, okay, late January and into February, the XIV was hit superbly hard. Okay, and they actually stopped trading the XIV, leaving the SVXY as the venue of choice. Now I'm going to key off on Joseph's comment here a little bit. Exactly. They got rid of the XIV. Now, because we're looking at the daily roll and not the charts, Okay, we were 3 weeks removed from that XIV. We were nowhere near being long the XIV when it crashed. I'll just say that. All right, and that's because we're looking underneath at something completely different that I'm explaining right now. That's the daily roll. So we understand the descending term structure and the upward term structure that I just showed you. But know that we now use the SVXY as the and actually the SVXY is superior to the XIV in that there's something called volatility drag that is much better on the SVXY. And so it just seems to recover far better than the XIV did, and the results backtesting with the SVXY are far better than the backtested results with XIV. We're very happy with this. Let's go back to this. Both the VXX and the XIV and the SVXY are constructed in such a way that they actually own, as in the case of the VXX, or are short, as in the case of the SVXY. This is the important part. The two VIX nearest month futures. Okay? Each day part of the position is rolled forward so that a constant 30-day forward position is simulated. Very important there. When the term structure slopes upward, like what I just showed you, which it does most of the time, that daily roll is a debit. Now I'm going to show you an example of this in just a second. No worries there. I'm going to show you an example of this daily roll. But that daily roll is a debit, and it is a drag on the performance of the VXX. However, since the SVXY is the opposite, that daily roll is a boon to the SVXY. Okay, I'll show you an example. Conversely, when that term structure of the VIX future slopes downward like a bear market, the daily roll then forward for the VXX is a credit and allowing it to outperform the VIX, and that daily roll is a detriment to the SVXY. Let's look at an example of here. Let's go to the left. Go to the left. Let's assume that you own shares of the VXX. Okay? Your money is being used to adopt a long position in the front 2 months of the VIX futures. Now, every day, okay, every day, a little bit of the front month needs to be peeled off and a little bit more added to the next month out so that we can maintain our 30-day forward position. That's what your money is being used to do, is to maintain a 30-day forward position. Every day we have to peel off a little of the front, add a little bit to the back. At these prices, we would be selling at 10.90, buying at 12. We would be selling low, buying high. That's a debit, and that debit can actually hurt the value of the VXX to a measurable degree. In fact, our subscribers have access to an indicator that tells you precisely the theoretical amount of that, the effect of that daily roll. And it can be significant. I'm going to show you an example of that at the end here. Okay, let's go to the right side. Let's assume that you own shares of the SVXY. Okay, that means that your money is being used to adopt a short position in the front 2 months of the VIX futures. Every day we have to peel off a little of the front, add a little bit to the back, meaning that we're going to buy a little bit of the front, sell a little bit more of the next month out. At these prices, buying for 10.90, selling for 12, buying low, selling high, that credit will positively affect the price of the SVXY. And again, we have an indicator showing you exactly the amount of that daily roll's effect on the price of the SVXY. So this is the effect of the daily roll, and this is what we mean by daily roll. Okay, so with that understood, let's go back to the Macmillan as he tees off on this idea. So the idea behind the trading system is simple enough. When the VIX futures slope upward steeply enough, like what I just showed you, that's a roaring bull market, and we want to own the SVXY because the daily roll in that situation is beneficial to the SVXY, and because VIX is expected to decline. Now, on the other hand, when that slope is downward like a bearish market, we want to do the opposite and own the VXX instead because the market's bearish VIX is increasing, and the daily roll then is beneficial to the VXX. So folks, it's kind of like this. We are looking at the daily roll. We're monitoring that daily roll. And when that daily roll gets strong enough, it's like being in a sailboat, I guess you could say. When that daily roll kicks in and gets strong enough, we're going to put up the appropriate sail, and we're going to go in that appropriate direction. If the daily roll is benefiting the VXX, we're going to go long shares of the VXX. And we're going to stay in the VXX as long as the daily roll is strong enough. When the daily roll subsides, okay, we're going to then pull in the sail. We're going to then go into cash and wait. And we might wait a couple weeks or more, waiting to see which way the wind is going to blow. And you know what? If the daily roll kicks in and is benefiting the SVXY, we'll go to long shares of the XVXY and stay in it for as long as that daily roll is strong enough. All right. Now, every good sailor has good navigational tools. And what are the tools that we use to time these sails going back and forth, or the entry and exit from these different ETFs? Okay, let's take a look here. This is what we use. And hopefully I'm going to answer some of Joseph's questions here. All right. So the VIX diff, so we call it the VIX diff. All right. That's what it's an indicator that we have built in OptionVue that measures the difference in the prices of the front 2 months. We measure the second month minus the first month. In this case, you can see February minus January. February is trading at 12, Jan's at 10.90. That difference is $1.10. Okay, now we cannot. And then now, if this was inverted, if we had a downward term structure and Jan was higher than Feb, the number could indeed be negative. All right, and we can't put a negative value in our last column in OptionVue. Stocks cannot have a negative price. So what we do is we use a base 0 of 10 and add that $1.10 to the value of 10. Or if it's inverted here, then it would be under 10 in the 8s and 9s. And we just put that actual $1.10 in the change column of the VIX diff indicator here. All right. So if it's in the 8s and 9s, you'll know that we have a descending term structure, and if it's above 10, we have an upward term structure. Now, OptionVue has taken this VIX diff. We've gone back many years, collected the data, even to the point of having open, high, low, and close of the VIX diff. All right, intraday VIX diff. Isn't that something? We go back many years on this so that we could then apply indicators and all that and back test. And so this VIX diff data becomes very important. So here's the base 10. Okay. And our first indicator we used was simply a 15-day simple moving average. And that's what we used in the early days of coming out with this philosophy. But after a while, it became clear that we could improve the signals by altering the moving average that we used on the VIX diff. And that's what you see down below is the Yates volatility indicator, or the Yates VXX indicator, the YVI. Now notice that the blue line here of the moving average, okay, is similar in appearance to the YVI that you see down below. And so the Yates VXX indicator is really a 15-day moving average of the VIX diff that we've proprietarily adjusted and altered. You can kind of see there's similarities, but we did alter the moving average for various things and made it such that the signals turned out to be far better by altering that moving average. And what we've done now is we take this indicator and apply it to a set of thresholds. We rescaled it, of course, and here are the thresholds. And as a subscriber, you get access to this indicator, and you can monitor the thresholds yourself. So when the YVI crosses above 0.96, all right, that is a signal to go long the SVXY. And so here's the SVXY area up here. Okay. When it goes back down below plus 0.7, that's a signal to go into cash. All right. Now, so those are the thresholds for the SVXY. On the downside, when it descends below negative 0.7, that's a signal to go long the VXX. And when it ascends above negative 0.5, that's a signal to go into cash. And then, of course, up here we have the SVXY. So we have three different zones coming from the YVI. The VXX zone, the cash zone in the middle, and then the SVXY zone above. These pink lines here are called the danger indicator. That's explained in another video that Lentz did a great job of explaining. It's a discretionary indicator our subscribers get, and it's a topic for another time. This signal from 2011 to go long the VXX, we were in the market, went about 4.5 months there. Let's take a look at the results of that. This happened in August of 5th of 11 to go along the VXX, exiting over here for a gain of 15.15 to 23.4. That was a gain of 50% on that, what, about 3.5 month holding period there. So just outstanding. I have one final point to make. Then I'll show you what to do after this, and I'll take some questions as best I can. Here we go. Let's one last point here, and that is to just revisit the premise that we want to always be in a position to take advantage of a strong daily roll. To take advantage of a strong daily roll. Now, how big can that daily roll be? We've been talking about it forever here, right? Let's take a peek. Here's an example from January 2nd. These are the same prices I showed you before. We're in a bull market, of course. And with the SVXY sitting at 132.78 back then, all right, the SVXY daily roll effect, DRE, all right, was at that time at 50, the daily roll was at 58. 58.58, 58 cents. How much is 58 cents relative to 132.78? When you run the numbers, 58 cents turns out to be 0.44%, just under 0.5% for that day. Now there's 30 calendar days in the month. We're looking at the calendar days here. When you multiply that out at that pace, that's a 13.2% pace for your daily roll effect, just for that 1 day's effect on the daily roll. And I'll tell you what, I've looked at this a long time. That 0.44% is right in the meat of where we want to be if we're going to have a position. All right, a lot of times it's much more than 0.44%. It's over 0.5% for the day. But if we're going to have a position, we want it to be substantial enough that it counts. So you can imagine, though, imagine this. If you're only in a position when you have a strong daily roll and you're never in a position when the daily roll is negative or flat, you can see then how this could be possible, where you can have these kinds of returns kick in and have some fantastic exponential returns kick in, and capital can grow very rapidly over time. Okay, so if this is something you're interested in, what do you do at this point? Where do you go from here? And what we'd like you to do is educate yourself further by watching 2 more videos available at the VXXTradingSystem.com website. Also, the email you received has some links to go back and take a peek at those 2 videos, and those were both done by Lentz, our founder and president, and he did a great job. He used animation software to explain the concept, why if there are these instruments trading like this, that the phenomena of volatility and the markets going up and down and the institutional managers, the effect I just explained has to persist. Also, we have an ebook that you should have received, or at least a link to it. Check that out. That gives you kind of a written narrative of everything I explained here today. And so whether you like to read for your information or look at videos for your information, both approaches should help you. Get yourself up to speed. Then we'd ask that you subscribe. You can go to VXX Trading System, hit the subscribe button. It's $1,200 for the year. It's a 12 calendar month subscription for $1,200. With that, you get trade alerts, or emailed trade alerts going out whenever we get a signal in the middle of the trading day. You are alerted to that with at least a couple hours to spare. I went back and looked at all the signals I received and had those easily with a couple hours to spare to get in and out of positions. You get access to all the indicators I showed you today and more. We give it to you through a member section of our website and also within the software itself. I'll show you a screenshot in just a second. And then we have an end-of-month email in the subscriber forum. Here is a screenshot of OptionVue, and we duplicate this on our website as well. We show you the futures prices for the VIX futures. We give you the data roll effect numbers, as well as the YVI, the danger indicator, and everything is given to you so that you can participate in the forum and just kind of be aware as to where the status is on all the signals we generate here. Okay, let's take any questions at this point. I'll do my best. I'm seeing quite a few. Let's see. So Joseph, hopefully I kept going and answered some of your questions. You made some comments about staying alive. Let's see, only not enough for staying. Yeah. Let's see. Yeah, we do not have auto trading, so we would give you the signals saying basically to that the signal is flashing to get in or out of one of those or back into cash. And so we are just monitoring the YVI, and you can monitor it as well, but when it crosses one of those thresholds, we will flash out an email advisory alerting you to the fact that the YVI crossed one of the thresholds I just described for you. Again, you as a subscriber, you can watch it yourself and bring up the charts and look, or you can wait and not look at it, and you'll get an emailed alert when it does cross a threshold, and we send out an alert for you. Okay? And exposure levels, Joseph, I mean, you saw what the drawdowns were, and you would have to, of course, size your positions according to what your portfolio is. That's something for you to decide on. We're not going to personalize our advice to you. We give out the educational signals, and I hope you can appreciate we have to be careful of that, but in terms of exposure, we certainly advise all our folks to be very aware of the risks given the historical drawdowns that we've both back tested and forward tested, and of course we understand that theoretically you can have drawdowns even beyond that. So, but definitely size your positions conservatively and understand the risks. It's very important. But understand also we do give you access to something called the danger indicator. Go back and watch those videos, and you'll hear Len talk about the danger indicator and what that means as well. Okay. Wonderful. All right. Awesome. Folks, thanks so much for joining us today. I hope this has been helpful. We look forward to you educating yourself further, and we would love for you to become a client of ours and for us to assist you in acquiring some of these wonderful returns I've just showed you here today. Thanks so much. Take care. Have a great rest of the day. Bye-bye.